What's going on, investors? My name's Emmanuel and welcome to my channel. If you clicked on this video, then you probably like the idea of receiving passive income from investing in dividend stocks. Well, you're going to love this video because today we will be going through the top 10 highest yielding dividend paying aristocrat stocks in 2020. I'm pumped for this video, guys. Let's go. Okay guys, so before we run through the list of the highest dividend yielding aristocrats, allow me to explain what a dividend aristocrat is. Dividend aristocrats are a select group of 66 S&P 500 companies that have consistently paid and increased their dividend payments for the last 25 years. They are the best of the best dividend stocks, and today I will be revealing the top 10 highest paying dividend aristocrat companies. In 10th place, we have Consolidated Edison Inc. Ticker symbol ED. They are in the utility sector. They have a dividend safety score of 90 and they have a fair dividend yield of 4.06%. In 9th place, we have Federal Realty Investment Trust, ticker symbol FRT. They are a REIT. They have a dividend safety score of 60. They have a decent dividend yield of 4.20%. In 8th place, we have Realty Income, ticker symbol O, and I've done an analysis on this company before, guys, so definitely check that out. They are a REIT. They have a dividend safety score of 70. They have a nice dividend yield of 4.49%. In 7th place, we have Franklin Resources, ticker symbol BEN. They are in the financial sector. They have a dividend safety score of 70. They also have a cute dividend yield of 4.76%. In 6th place, we have AbbVie Inc., ticker symbol ABBV. They are in the healthcare sector and they have a dividend safety score of 50. They also have a beautiful dividend yield of 5.07%. In 5th place, we have Chevron Corp, which needs no introduction. Ticker symbol CVX. They are in the energy sector. They have a dividend safety score of 65. They also have a delicious dividend yield of 5.12%. In 4th place, we have People's United Financial, ticker symbol PBCT. They are also in the financial sector and they have a dividend safety score of 79. They also have a fantastic dividend yield of 5.35%. In 3rd place, we have AT&T, ticker symbol T. They are in the communications sector. They have a dividend safety score of 65. They also have a sexy dividend yield of 6.35%. In 2nd place, we have ExxonMobil, another company that needs no introduction. Ticker symbol XOM. They are in the energy sector. They have a dividend safety score of 55. They also have a scrumptious dividend yield of 6.56%. And in 1st place, we have Altria Group, ticker symbol MO, and they are in the consumer staples sector. They have a dividend safety score of 55, but they have the highest dividend yield of all aristocrats, sitting at 8.02%. Okay guys, so I can appreciate that there are quite a number of new people to investing that are following my channel, and I also can appreciate that I did actually glance over what the S&P 500 is. So I wanted to just give a clear description of what it is, and if you already know what this is, I apologize. But I do want to ensure that new investors understand exactly what the S&P 500 is. So the S&P 500 is an abbreviation for Standard & Poor's 500 index, okay? An index is pretty much a method that tracks the performance of a group of assets. All right, guys? So in this instance, we're talking about the S&P 500. So this is an index that tracks the 500 largest US publicly traded companies, okay? So in UK terms, the UK version of this is called the FTSE. And if you live in the UK, I'm sure you must have heard of the FTSE's gone up, the FTSE's down. But pretty much the FTSE is our version of the index. And the FTSE 100, that tracks the 100 largest UK publicly traded companies. We do have another index, which is called the FTSE 250. But predominantly, we look at the FTSE 100. We give that the most attention in this country. And guys, if you want us to do any further reading, you can go on this link here, investopedia.com, and just literally type in S&P 500, and it will give you a lot more information for you to read and do your own due diligence. So with that said, guys, I just wanted to quickly go through my top 3 favorite dividend aristocrats. And they are Realty Income. And again, I've done a detailed analysis of Realty Income. So please click the suggested tab above. Now, in second place is AbbVie. I do like AbbVie Inc. And third place is ExxonMobil. And I put high risk, guys, because it is an energy company and the energy sector is taking a hit at the moment. Even though it's recovering quite nice at the moment, but it's still, I'll put it as high risk, okay? So let's quickly look at the financials of AbbVie Inc. and ExxonMobil. Okay guys, so we're looking at AbbVie Inc., alright? The market price is at $93.85 and the earnings per share is sitting at 5.65. So that gives it a PE ratio of 16.61. And again, guys, to do the maths, if you want to do the maths on this, all you have to do is the market price, which is 93.85, divided by the earnings per share, which is 5.65, and that will give you the PE ratio of 16.61. And what that pretty much means is at the current earnings per share, it will take you 16 years to get a return on your investment. Alright guys, and the reason why I like AbbVie is just by looking at their revenue growth. I mean, from 2013 you can see it's been nice and consistent with their revenue growth, although it did slow down in 2019, which is a little bit concerning for me. But its previous history is quite good, but that is a little bit worrying. They have had a slowdown in revenue, and that's something to definitely take a closer look at. And also their earnings, their net income as well, as you can see, had a dip in 2014. It recovered in 2015, 2016, but again, the net income isn't as consistent as I would like it to be. And you would have, if you watch my other videos, you would know how we like the beautiful, consistent growth because it then becomes predictable. But it had a good 2019. Alright guys, so again, we have to look at the balance sheet. We need to make sure it has a strong balance sheet, and that's one of the reasons why it's in my list. As you can see here, the total cash position as well has grown. It had a good 2019, so the total cash is sitting at 36 billion. But it was a bit stagnant between 2016 and 2018. But the good news is that this last year had a solid year and the cash position has grown quite significantly. The total current assets is sitting at 46 billion. And the total current liabilities, which is nice and healthy, sitting at 15 billion. So that gives it a nice current ratio. But the main thing that attracted me to AbbVie, guys, was the sales growth expectations from the analysts. You can see it's pretty much in line with what a typical growth stock would you would expect. So these numbers are quite high, 23% by June, so this quarter. By next quarter, they're expecting a 49.8%, 49.80%. By the end of the year, 37.40% growth, and by next year, 16% growth. So I think with AbbVie, as long as they can keep to these expectations or even exceed it, I would expect their market price to increase. Because if we're going by what Peter Lynch advises, he always talks about follow the earnings, follow the earnings. And also taking a look at AbbVie's market action, you can see here off its all-time highs, it's currently at 25% below its all-time highs. So that still gives it room for growth. So I think if AbbVie continue with positive earnings and continue with positive sales growth, I think there's still room for us to capitalize on a good move upwards. But like I said, guys, we're here for the dividends at the end of the day. I don't really care what the price does. I'm just in it for the dividends and also for capital appreciation. And I think AbbVie ticks both boxes. Okay, guys, and looking at ExxonMobil, as we go through their financials, you'll be able to determine why I consider it high risk. You've got a nice PE ratio that sits at 19.92.
The earnings per share is at 2.66, and again, it's got a beautiful dividend yield of 7.09%. Having a look at their operating margin, and it's currently sitting at 3.48%, which is considerably a lot lower than its competition, CVX, which is Chevron. Looking at their balance sheet, again, they've got 11.41 billion in cash versus their total debt, which is 59.61 billion. The current ratio is also sitting at below 1. It's sitting at 0.78, and I do like a current ratio that is 1 or higher. So also looking at the analyst expectation, guys, again, and it's not great, minus 51.50%, minus 40%, and by the next quarter, current year is sitting at minus 29.70%. I mean, the only good thing about Exxon Mobil right now is that the economy is opening up. A lot of countries are lifting their lockdown and easing their lockdowns. So hopefully that would go for change. But ExxonMobil, I haven't invested in that company just yet. I've still got it on my watch list. And taking a look again at its 52-week high, it's currently sitting at 36% below its 52-week high. So with the economies opening back up, it might be a good position to take and enjoy the nice high dividends while getting the capital appreciation as well over time. But that's my take on ExxonMobil, guys.
Now remember guys, don't invest in companies purely for its dividend yields alone. Pay attention to their earnings. Make sure they have a solid, strong balance sheet before you decide to invest in any of the companies that I've listed today. Guys, if you want to check out my analysis of the best monthly dividend stocks, click here. If you want to check out my top 3 growth stocks, then please click here. That said, guys, destroy the like button, smash the subscribe button, and hit the notification bell for more. Take care, guys, and I'll see you in the next one. Peace.